All right, guys, moving on to Unit 23. We have two more units, I believe. So let's get through this. We're almost there. So closing the real estate transaction. These are what we're going to identify, describe, explain, and distinguish. Why learn about closing the real estate transaction? I was telling the class the other day, why is it so important? Because when does a property actually sell? When everybody gets their money, right? So a sale isn't a sale until people get paid out or till keys get exchanged properly. So during the buying process, the buyer's issues that can occur is title inspection, final property inspection, and survey. So many times, we've gone to final walkthroughs the day before or the day of, and there's flooding in the basement. That could be a big issue, right? Surveys. If your client's buying a property that kind of looks like this, where he has all this extra land, and come to find out that his property is like this, and he only owns this, guess what? Someone's going to be very upset. And would that affect the sale of the property? Yes. Seller's issues. The seller's main interest is in producing adequate documentation so that the closing can go forward and they can be paid. Of course, everyone wants to get paid. Title procedures. Both the buyer and the buyer's lender will want the assurance that the seller's title complies with the requirements of the sales contract. In Illinois, if you guys remember the Chicago Bar Association, Quinlan and Tyson, basically we as realtors cannot fill in the blanks for our clients, and we cannot make any of our own forms. Everything has to be done through either the attorney or through the association, and that's where we get all our contracts. Face-to-face closing. Closing agents or closing officers will be there. The exchange. So when we go to face-to-face closings, you might have the attorney, or pre-pandemic, you might have the attorneys, both buyer and seller, both agents, and then you have a closer there, sometimes a loan officer. And then, if anything goes wrong, whoever's there can help dictate things, and then you do the exchange of keys, and then you're kind of good to go. Closing in escrow. So escrow procedure. The doctrine of relations back protects the validity of documents placed in escrow, even if the signer of the document dies before the escrow is completed. So escrow is meant as kind of like a third-party account, right? So there's a lot of things that could go into escrow. Repairs, taxes, insurance, things like that. It depends who's opening up the escrow and what the escrow is used for, which will be determine how it gets closed out. So sometimes there's earnest money that goes into this escrow and it gets closed out at closing. Why? Because they end up using that money to purchase the property. So anybody receiving money in the transaction is usually going to get a 1099 form. Information included on the form of 1099-S is the sale price, amount of property tax reimbursement credited to the seller, and the seller's social security number. Your 1099s are going to come from your brokerages. Broker's role at closing. It varies depending on local practices. So sometimes you have to go there for final inspection. Sometimes you have to go get transfer stamps. Everything's depending on what that city needs from the seller or the buyer. That dictates what your job is. Lender's interest in closing. Protect its security interest in the property. Guys, very important that when you're at the closing table, that your client's not over talking on certain things that they want to do with the property. Maybe it's their first property and they're renting it out, and guess what? That's illegal. That's mortgage fraud. Why? Because it's not meant to be used as an investment property. They're there for mortgage lien to have priority over their liens or over other liens. Insurance escrow or impound account created so the insurance will be available in case the property is destroyed. Tax escrow or impound account created at closing so it can control the payment of real estate taxes, which they'll do. Mortgage Disclosures Improvement Act states that the timing of certain disclosures now affects dates at closing. The Real Estate Settlement Procedures Act, which is the RESPA. So with this, with the RESPA, if you go to page 446, it should be there. The Real Estate Settlement Procedures Act, RESPA ensures, sorry, let me put this for you, page 446. So RESPA ensures that consumers are provided with important, accurate, and timely information about the actual cost of selling or closing transactions. It also eliminates kickbacks or other referral fees that tend to inflate the cost of settlement unnecessarily. So every single penny that gets paid out to whoever it may be will be on that settlement statement or closing disclosure or HUD statement, whatever they end up calling it. This is very important. So a debit is a charge against the party. A credit is the amount entered in a person's favor. If you go to page 451, you should see a chart. So on page 451, you should see a chart that dictates what gets debited and what gets credited. So the best way to remember is C equals receive, and so page 451, and D equals give. So if you're debiting, if you're getting debited, you're giving back something. Okay. If you're getting it credited, you're getting something. You're receiving some type of money. Calculating a buyer's cash at closing. So who's going to dictate that? Our lender. The buyer's debits are totaled with the major item being purchase or being purchase price. Any expenses and prorated amounts for seller prepaid items are added to the purchase price. So like taxes, right? If they pay taxes in the beginning of the year, guess what? The buyer might end up having to pay back some of the taxes because they were prepaid. Then the buyer's credits, including earnest money deposits and loan procedures, are totaled. So the earnest money will be brought to the closing table. Finally, the total of the buyer's credits is subtracted from the total debits, and that will be all done for you on the settlement statement. Calculating the amount to be received by the seller's credits are totaled with the major item being purchase price. The total of the seller's debits, including existing mortgage payoff, is subtracted from the total credits. Loan fees. These loan-related costs are charged to the buyer at closing. So everything is pretty much done at closing. Tax reserves and insurance reserves, aka escrow accounts. Most mortgage lenders require that borrowers provide reserve funds or escrow accounts to pay for future real estate taxes and insurance premiums. That's why people ask how much their total bill is going to be, because the mortgage payment will include the insurance and the taxes in there unless they opt out of it. But that has to be a dictation based off the lender. Let's see. Appraisal fees. The cost will be charged to the buyer, but often the buyer has prepaid it as part of the non-refundable application fee. It will show up as an expense paid outside of closing. Survey fees. In Illinois, most real estate contracts require that the sellers furnish a current survey to the buyer. As a result, the expense of preparing a survey is usually borne by the seller. Additional fees. FHA lump sum for payment of mortgage insurance premiums, MIP, if it is not financed as part of the loan, and it will be charged to the buyer. VA funding fee paid directly to the VA at closing will be charged to the buyer. Conventional, if the loan carries private mortgage insurance, PMI, the buyer prepays 1 year's insurance premium at closing. Accrued items, expenses that are owed by the seller but will be paid by the buyer after closing. The seller pays for these items by giving the buyer credit for them at closing. Sellers will be charged for their share in the form of a debit. So at the end of the day, everyone pays their equal share. Prepaid items, expenses that have been paid in advance. Seller receives credit for unused portion. Guys, this is very, very important. So pay attention to this. Pay attention to this. Per the test, if it doesn't state otherwise, use the statutory method, meaning 360 for the day, 12 months, and 30 days for each month. Actual numbers go by 365, 366 in a leap year, so you could see how that could get a little bit confusing. So per your math problems, start using 360, 12 months, and 30 days. And again, always do it yearly so that you could break it out into whatever you need to break it out later if you need to. A third method, the statutory month variation, is also acceptable for inexpensive residential properties. Don't worry too much on that. This is more for the math problems, okay? General rules. The rules or customs governing the computation of prorations for the closing of a real estate sale vary widely from state to state. Guys, the prorations will most likely be taken care of by your attorney, but we do put the initial prorations on the contract. The seller owns a property on the day of closing, and prorations or appointments are usually made to and including the day of closing. Real estate taxes and mortgage loan interest are some of them. In Illinois, taxes are paid in the year after they become a lien. If there is an unpaid installment that has been billed, this actual amount is credited to the buyer and debited to the seller. The buyer must also be credited with the current year taxes, and the seller debited according a proration from January 1st up to including the date of closing. Okay, so this is what I was talking to you guys about, the math portion of it. So the statutory year, right? So as you see here, how many months is it? 12. Or how many full months are there? So 7 full months, and then we have these extra 12 days. So what did they do here? The sale is set to close on August 12th. The current real estate taxes are $1,500. So they did 1,500 times 12 gets you $125 per month. So going back to statutory method. So 125 per month, and then they did the 125 divided by the 30 days gives you $4.16. So how much will the buyer and the seller be debited or credited? So what they do, they took the total months, so they did 125 times 7 gives you 85. They took the 12 days and multiplied it by the daily rate, which is $50. They added it up together and gives you right around $925. Okay, $925 was credited to the buyer and debited to the seller. Okay, so here's another one. Here's another way of doing it. So you've seen that they're doing the different variations. So you could pause this and take a look at them. Pause and take a look if you'd like. Closing disclosure. This is what closing disclosures look like. So we see on here the loan amount, the interest rate, monthly principal, and interest. Look at these people do have prepayment penalties. Do we have prepayment penalties in Illinois? No. Here's the total monthly estimated cost. Look at from year 1 to 7 and year 8, it goes down a little bit. Property taxes are included in this, homeowner insurance, and homeowner association dues. So there are some, but they're not included in this total monthly. This is how much the closing cost was, and this is how much they have to bring at closing, the cash to close. What is the customary procedure for closing real estate transactions in your part of Illinois? Does the custom vary from one area to another? Yes. Each area has its own way of closing. Cicero closes different, Berwyn closes different, Burbank, North Side, South Side. Chicago has their own way of doing things. The process by which expenses are handled at the settlement of the real estate transaction so that both the buyer and the seller pay their respective portions of the debits is called proration. True. The principal balance on an assumed mortgage loan is entered on the closing statement as a credit to the seller and a debit to the buyer. False. It's a debit to the seller and a credit to the buyer. So you could pause here. Let me see. Remember TRID, 3 business day rule.